Hey everyone, and welcome to this explainer. Today, we're embarking on a deep dive right into the complex, incredibly high-stakes ecosystem of digital dollars. Specifically, we're going to break down the anatomy of USD coin, or USDC. It's a digital asset that is, quite literally, rewiring the foundation of global finance. Let's get into it. $2.7 trillion. Let that number just sink in for a second. While the total stablecoin market is already pushing massive volumes today, projections from major institutions like ARK Invest suggest that stablecoins could actually account for a significant percentage of the global money supply by 2030, scaling way past the trillion-dollar mark. And really, this raises the ultimate question we need to be asking. Who will actually control the future of digital money? Are we talking about traditional banks, agile tech startups, or governments?
All right, Section 1, the digital money landscape. So as you can see laid out here, it's essentially a massive battle between the private and public sectors. On one side, we have stablecoins like USDC. You can think of these as nimble speedboats. They're issued by the private sector, they're borderless, completely battle-tested, and they run lightning fast on global blockchains to power the Web3 economy. Then on the other side, we have Central Bank Digital Currencies, or CBDCs. These are more like heavy cruise ships. They're government-issued, exist on entirely closed ledgers, and right now, honestly, their development is slow, deliberate, and largely just experimental.
Now, looking at the market breakdown, it is essentially a duopoly right now. We've got two superpowers dominating this space. Tether, or USDT, holds the commanding lead with about 58% of the market. But right behind it is Circle's USDC, commanding a really massive 25% share. Tether definitely has that first mover advantage, but USDC has managed to carve out a whole quarter of the market by playing a very different game. Which brings us to Section 2, building the compliant dollar. So how exactly does Circle protect its turf? Well, their strategic mode is their absolute relentless focus on compliance. For every single one of the 72.7 billion USDC currently in circulation, there's an actual US dollar equivalent held securely in reserve. If we look at the composition, about 85% of those reserves are held in US Treasury money market funds, which are managed by giants like BlackRock, while the remaining 15% sits as cash deposits in global systemically important banks. It is highly liquid and incredibly secure.
But the best part is, they don't just ask you to blindly take their word for it. You can see the visual proof right here. Circle actually utilizes monthly attestations from top-tier independent auditors like Deloitte to guarantee their one-to-one reserve backing. In an industry that has historically been plagued by some pretty opaque reserve practices, Circle's decision to just proactively open their books every single month, that's a massive competitive advantage.
Moving on to Section 3, the Circle Profit Engine. $1.67 billion. That was Circle's staggering revenue in 2024. And the secret behind this massive figure? Surprisingly, it's not transaction fees. It's almost entirely driven by the interest earned on those massive reserve assets we were just talking about. Circle operates a lot like a traditional bank, right? They take non-interest-bearing deposits from users, they invest them in safe, short-term treasuries, and they just keep the yield. In a high-interest rate macroeconomic environment, this model, well, it practically prints money. But if we look at the financials graphed here, there is a catch to their profitability, and a rather expensive one at that. Yes, revenues hit $1.67 billion, but look at this. A massive $1.01 billion was completely eaten up by distribution costs. To keep USDCs circulating and to actually incentivize crypto exchanges to hold and promote their stablecoin, Circle has to share a huge portion of that reserve interest. They are literally paying out over 60% of their income just to maintain their market position. So you're probably wondering, where exactly is all that money going? Well, out of that $1.01 billion in costs, a jaw-dropping $908 million was paid directly to Coinbase in 2024 alone. Coinbase and Circle co-founded USDC, and through a pretty complex revenue-sharing partnership, Coinbase gets a massive cut of the reserve interest based on the amount of USDC held on their platform. It's an incredibly effective distribution channel, but undeniably a very expensive one. All right, let's pivot to Section 4, choosing the right network. Look, if you're building a payment business today, network speed is absolutely everything. Ethereum, which is the birthplace of USDC, averages a 15-second block time. Now that's reliable, sure, but it's relatively slow in the fast-paced finance world. You step down to Stellar at 5 seconds or Polygon at 2 seconds, and it gets better. But out on the bleeding edge, Solana boasts a blistering 400 millisecond block time. The network you choose completely dictates your user experience. It's the difference between the speed of sending an email down to the instant gratification of a credit card swipe. Now, with USDC spread across so many of these different networks, liquidity naturally gets fragmented. To solve this giant headache, Circle introduced the Cross-Chain Transfer Protocol, or CCTP. Basically, it allows for intermediary free transfers of USDC across all these isolated blockchains through a seamless burn and mint process. Now, I know burn and mint sounds a bit like a harsh gym workout, but it simply destroys the USDC on the sending chain and mints an identical amount on the receiving chain. It's a brilliant innovation that effortlessly unifies the entire global USDC supply.
Which finally brings us to Section 5, Navigating the Hidden Risks.
Because here's the reality. All that seamless underlying tech we just discussed, it relies on code. And unfortunately, code can be flawed. So what actually happens when the smart contracts fail? Well, we saw a really stark reminder of this vulnerability when a hacker exploited a flaw in the DeFi lending platform dForce, stealing $25 million. Now, while this wasn't a failure of Circle's actual token, it really highlights the immense counterparty risk that's inherent when you're using digital dollars inside complex decentralized finance protocols.
But honestly, the ultimate nightmare scenario for any stablecoin is depegging. As defined here, this occurs when a stablecoin completely loses its guaranteed 1-to-1 value ratio with the US dollar. You have to remember, in the world of stablecoins, trust is literally your only real currency. The exact moment a token drops to 98 or 95 cents on the dollar, it shatters that trust, it violently liquidates smart contracts, and it causes immediate systemic market panic.
And look, this isn't just theoretical. If we walk through the recent timeline, the history of stablecoins has been incredibly turbulent. Back in 2022, we saw the catastrophic collapse of the Terra algorithmic stablecoin. Then, in March 2023, right during the Silicon Valley Bank crisis, Circle temporarily lost access to over $3 billion in cash reserves, causing USDC to briefly depeg. These exact shocks directly spurred the passing of the Genius Act in July 2025, which finally came in and established strict federal compliance and reserve standards for the entire industry. So, to wrap this all up, we know Circle is highly compliant. And we know their massive revenue is almost entirely dependent on the high interest rates paying out on their Treasury reserves. But macroeconomic environments change. So I want to leave you with this one thought. If global interest rates drop back to near zero, stripping away their primary source of income, can Circle's profit engine actually survive? It is the multi-billion-dollar question that will ultimately define the future of the digital dollar. Thanks so much for joining me on this explainer. I'll see you next time.